Well, good morning, ladies and gentlemen. Let me first of all wish you a very, very happy New Year. Over almost 25 years, last 25 years, we began with Dr. Alan Sinai to share his illuminating insights and penetrating views on the global economic and financial situation and the outlook for world economy in that particular year. We've been doing that for almost the last 25 years, and he never disappointed us in providing his very brilliant analysis and the outlook. Well, this year, the timing can be more the appropriate, because this year began with a very severe Chinese equity market turbulence and very rapid renminbi depreciation. And there are shock waves spreading all over the world, particularly emerging economies, which rely heavily on energy and commodity exports. So we wonder what all this sum up to and what it means. So this is the perfectly right time to have Dr. Alan Sinai will tell us what's happening not only in China, in the US, in Japan, and all over the world, and what will happen in the future. So it's most timely the lecture from Dr. Sinai. Well, before I invite him Dr. Sinai to the podium to speak, I would like to take a brief moment this morning to let you know that the Institute for Global Economics just appointed a new president, Dr. Kyung-Jin Song, who is now currently the vice president of the Institute. Dr. Song, most of you know her well, but she earned her doctoral degree, PhD degree, from the University of Kansas, and since then she has been working various international organizations and the Korean government. In fact, she was my colleague, my assistant, my associate for many years, and she worked with me for National Competitiveness Council and the G20 Summit Committee, and she is virtually running the Institute for Global Economics. So she now just got the new the presidency, so I'm sure she will be more active. In fact, with her new tenure at the IGE will focus more on our female workforces and aging issue and low birth rate and everything. Which is all related. It has a lot to do with our economic growth potential and the future of the Korean economy. So we are looking forward to more activities in these areas. In fact, we have many female leaders in Korea to congratulate her this morning. Thank you very much for coming, and we have Minister Kim, who was Minister of gender equality and female affairs in Korea in the previous government. And then we have many ambassadors here, and from Switzerland, Egypt, and Netherlands. Well, so where is that song? Yeah, just say a few words to the.
Thank you, Chairman Sagong. As Chairman Sagong said, the increasing the women labor participation, as well as increasing the quality and quantity of female labor, has been our government's policy priorities. Nonetheless, female labor force participation in Korea, as you all know, is still lagging behind our OECD colleague countries. Having said that, on behalf of the women leaders present this morning, I'd like to extend our heartfelt appreciation to Chairman Sagong for his sincere attention to the issue of women and female labor force participation. With that, I understand women leaders have something to present to Chairman Sagong. Sort of a gift.
이거 재주는 건 for you.
Thanks for you. I understand. I would guess something from a very young gentleman. From a very young gentleman.
Okay. Okay. Thank you very much for giving me this beautiful bouquet. I'm looking forward to more work in this particular area with Dr. Song. Well, with this, we have to begin our lecture. As I said, I always say whenever we have Dr. Allen Sinai, forecasting is a very hazardous business. And I think Paul Samuelson said some time ago, maybe in the 60s, he says, don't ever make a forecast. And if you're pressed forced to forecast the economy, then don't give numbers. And yeah, you are forced to give numbers, then don't give period, timing. Then you will be relatively safe. But he's very courageous enough. He already talked about numbers. But, Wall Street, a few years back, he was named as the best accurate forecaster in the United States. He's particularly good at the market, financial market. He himself, he is a scholar, and he is a practitioner and a government consultant, and he's a big investor. He's making a lot of money there too. So we can rely on him. Well, with this, let me invite you. Please join me in thanking you.
Well, thank you very much. Congratulations, Ilse Kong. Congratulations. Yes, there you are. Congratulations to you. I noticed perfect English. I understood every word you said. In fact, I was telling Ilse Kong, I come here, and it's one of the few places in the world where when people speak, I understand them because they speak English so perfectly. And in our country, everywhere I go, they only speak Spanish. And I don't understand the word. So I'm going back to college. I'm going to learn Spanish so I can understand what goes on in my country. The world's an amazing place. The internationalization of the world and the mixture of people from all over the world in different countries is just astounding. And the world is our topic today. I appreciate the comments on forecasting. John Kenneth Galbraith said, why do forecasters forecast? And his answer was, John did not do forecasts. He said, because they are asked and they feel they have to answer. And Paul, who I was fortunate to know, was smart enough to be very qualitative and very articulate, and so he avoided numbers. I'm not that smart. I work in a world of numbers, I always have. I eat, breathe, live, digest, swallow numbers every day from all over the world, and believe it or not, I actually enjoy that. So, and I enjoy talking to this audience at the beginning of every year. It's the highlight of my year, coming here, as I have for so many years, to speak to the Institute for Global Economics. The title today is Struggling for More Growth. Will this be the year? With a question mark. The answer, yes. The U.S. and global economies, more growth, a little more price inflation, but still very low, and declining unemployment rates, except in those countries where unemployment rates seem to be, and Korea is one of them, about as low as they can get full employment. Geopolitics and unforeseen oddball shocks, and we certainly have had lots of those over many years. It's a way of the world now. We know they will happen in 2016, but we can't forecast them. When they happen, we have to analyze them, like the latest stock market shock of a piece of bad data over a weekend out of China, and for the second time since August, stock markets plummeting, down 7% in almost no time, and the need for the Chinese authorities to shut them down. The ripples from that were felt in all markets. These days, the world is so incredibly tied technologically, informationally, and money is in different assets in different countries. We call that multi-asset, multi-country trading and investment, so that something that can happen in China has an immense effect on the world. Does that make sense? In a risk sense, it makes a lot of sense. China is now the second largest economy in the world. 1.3 billion people. That's a lot of people. Huge foreign exchange reserves being used lately on the currency. And so in a realized real sense in terms of purchases, for example, 25%, Joseph Gong tells me, of Korean exports go to China. What China sells and buys is just huge in the world. This was not true 10 or 15 years ago. It certainly was not at all true when I first spoke here for Lehman Brothers back in the 1980s. Lehman, I think, first opened an office in China in 1986 or 7. China was about that big in the world economy. The developing world, including China, now is about 1/3, as we calculated, of global output. And so developing countries, Korea is not one of those, Korea is a developed country in this category, are a huge deal. 10, 15 years ago, it was half of that. So it is quite rational for markets around the world to react to evidence of a slowdown in China and fears that something worse is going on. Because China is murky. China is not transparent. People who trade and invest don't really believe the numbers that come out of China. And when you see a piece of bad data in a situation where the economy is thought to be deteriorating, and at the same time, the currency, which is overvalued, even at today's prices of around, I think it's $6.59 or 60 to the dollar, we think it's overvalued, it's catching up. The currency comes down, all the markets shake and shudder. When you look at economies and business around the world, you have to be very careful not to take that and extrapolate it into the way of the world, the future of economies around the world, it is germane to financial markets, overdone, with lots of uncertainties affecting asset prices, because that's what happens to asset prices in the face of uncertainty. So I have to, as an analyst, try to look through that and ask the question whether the Chinese economy is really collapsing, which is what the market verdict kind of was. And whether the devaluation, the second one now since August, this was just a fixing of the currency to match a changed exchange rate regime of the Chinese economy, now that the currency is part of a larger basket of currencies, 5 currencies defined by the IMF, and not all by itself as it was before. That has been a big change. And assess whether the economy really is in very, very big trouble. If it is the second largest economy in the world, then in economies around the world, Korea, Japan, United States, Germany, they will keenly feel that. And yes, that is an increased risk of another global recession. And the noise and movements in the markets may turn out to be prescient. But that is not the view I have today about China, and the view we have in the research that we do. And that certainly is not in the statement of Mr. Ma, who is, I think, number 2 at the People's Bank of China, who says, as China said in August, and I do believe this, that the movement of the Chinese exchange rate is part of the exchange rate moving into line with other Asian currencies, which have already gone down immensely against the dollar. It is kind of a catch-up, and it is not a sign that the economy is collapsing. In the trading world, since there's always some chance something can happen, China's economy collapses, the only thing a trader can do on what went on over the weekend is to sell Chinese stocks if they were long. And there's a lot of selling that went on in China as well. And if you sell Chinese stocks, and if there is a chance that the Chinese economy is going to have a collapsing kind of result, then you have to sell stocks in Korea, in Japan, in the United States, because China is the largest, second largest economy in the world. And if Chinese GDP growth falls to 4%, you better sell now and not later. And that's what traders do. Now, when you do that, you have to take the money and put it somewhere, and so it goes to German bonds, it goes to U.S. Treasuries, it goes to the yen out here in Asia, because the yen within Asia is viewed as a safe haven currency in times of stress. And maybe you have to buy some gold as a trader to make a little money on the day, because traders have to make money every day. Otherwise, they lose their jobs. It's important to understand what goes on in a situation like that. The risk that is avoided and the herd-like fast moves of fast money, trading money, which are sometimes signs of something fundamental to come. Most times, it's simply making money on a day-by-day basis for those who move money that fast in what they do for a living. Nothing more than that. How do I know? Well, I lived and worked at Lehman Brothers for 13 years. I spent most of my time with traders, fixed income, currency, stock market traders. I have a trader's instinct. If something out there looks like it might be scary and hurt, I run away. I survived living in Detroit, Michigan. That was a tough place to grow up in the United States. And I learned how to run on risks. I look around, looked at some big threatening guy or even gals in Detroit where I grew up, and I just ran. I'm still here 70 some odd years later. So I fit in perfectly at Lehman because the traders were very risk averse. And the minute there was a chance something might happen. But here's the rationale of it. On what happened in China, because we don't know the veracity of the data. We don't know. It's not clear. on the chance that something bad is happening, even if I don't want to sell my stock in China and in Japan and Korea all at the same time because I sell a basket of currencies as a trader. I know the guy next to me or the gal next to me is going to sell it. And if they sell and I don't sell, what happens at the end of the day? I've lost money on my P&L. I get fired. That is part of what went on. What we now want to do, and what I'm going to say to you today, is the Chinese economy, yes, is declining. It's weakening. It bears watching. But the moves on the currency, it would be better if the Chinese would say very quickly why they were doing what they do. The moves in the currency are part of an adjustment in the Chinese currency against other currencies because the Chinese currency is fundamentally too high. It has to move down and approach the depreciation of other Asian currencies, competitors of China, against the dollar, and that means it will go down further. How much further? We are forecasting 7 to 7.25 on the Chinese currency against the dollar by the middle of this year. And I expect we'll see more fixings, and then we'll learn to get used to it, watch the Chinese data, and given the amount of stimulus that China is pouring in from the macroeconomic side, on monetary policy and fiscal side, and given what ultimately should be a shift, though it's slow, to a services economy and more consumption rather than exports, the Chinese economy will bottom out, move up, and all of this will be behind us. The timing of that, sometime this year. Between now and then, the kind of things that went on the other day could go on again. And back of it all, a suspicion, which would be good for the Chinese government and policymakers to allay in being as transparent as possible, as quickly as possible, telling everybody what's going on and why. I doubt that that will happen. That's not the way of the Chinese culture and world. But someday the markets will force that. And China will become much more transparent. The data will be better. And we won't have the kind of noise. Part of what went on is noise. So, more growth this year. It's a struggle. A little more inflation, but still low. Lower unemployment rates. And without oddball shocks, 2016 for the U.S. and world economies should be a better year than 2015, and 2017 even better. Stock markets shaking off the Chinese slowdown and the uncertainty around China, shaking off geopolitics, the latest conflict, Saudi Arabia and Iran, shaking off the incredibly large declines in crude oil prices, a fundamental supply-side shock that has given us oil and energy and gasoline prices around the world that will stay permanently lower. We believe it's permanent. It's now a year and 3/4, has immense effects. And there's lots of trouble from that. Argentina, Venezuela, Canada is hurt. The Middle East economies are hurt. Saudi Arabia now has to go to some outside financing as the Saudis keep production up to shake out the high-cost producers. It's a kind of a war here. And the U.S. is maintaining its position as the third largest crude oil producer now in the world lineup. And my belief is our companies will continue to do that. We see them slashing and burning, firing people, cutting investment to keep costs down so they can keep producing for the day, someday, when crude oil prices go back up, and it makes those companies rich and our country rich, just as all oil-producing countries have been rich. The Saudis forever, Russia for a while, no more. Russia is in a state of collapse on $31 crude oil barrel. That's one of the trouble spots of the world this year and next year. Who knows what will happen politically? The economy went down over 4% last year. We think it's going to be down another 2 to 4% this year. We're not sure how long. Even the allies, the buddies of Mr. Putin will stand for that. That's terrible. it's a horrible situation. It's all levered by oil. So there are all kinds of recessionary effects of that. In the United States, mining is in a depression. Manufacturing is in a recession. But the rest of the U.S. economy looks great. Those two sectors are tiny in the U.S. economy now. They used to be big. In the old days, the kind of data we're getting on manufacturing, I would be here telling you to expect a recession. It's too small. There aren't that many people in manufacturing anymore. 8.5% of our total employed are in manufacturing. 10 years ago, it was double that. The sectors that are strongest now in the anatomy of the U.S. economy are such things as healthcare, leisure and hospitality. They're all in services, education, professional and business services, which includes all the new stuff, all the people who are finding jobs, the software programmers. Total transformation. We can see it in the numbers. And the American consumer, 69% of the U.S. economy, exports are 13 or 14%. American consumer is in great shape on the fundamentals that we watch and have watched for years, astonishingly good shape, the pillar of strength of the U.S. economy. And for other countries that export to the United States, given the size of the consumer sector of the United States, a big plus, kind of an external stimulant from the United States via the consumer to countries like South Korea, Japan, China, Germany, to Europe, operating now. And so long as American consumption holds up, and we do see some risk, but not really scared by them, outside from external source, that external source comes some stimulus, and then relying on the monetary and in some cases fiscal stimulus of areas of the world and countries like Japan, China, the Eurozone and Europe, we would think that those economies will pick up, that eventually the fruits of quantitative easing, which have shown up clearly in the performance of the UK and performance of the United States, will show up in Japan, will show up in Europe. It already is. China is not doing quantitative easing, but the monetary stimulus of China, with a very low inflation rate, plenty of room to stimulate more, is going to keep coming. The currency is going to go down. And business people in Korea and elsewhere that compete with China will have to contend with that. We don't expect the kind of easing in monetary policy that is going to continue in China to go on in other countries. And on that alone, the Chinese currency needs to come down. It has to align. It has to get in line with other Asian currencies against the dollar. Interest rates should rise in the United States on average, not in Japan, not in Europe, not in China, where stimulus will continue along with stimulus from the American consumer to lift economies. In Korea, we think there may be some further monetary easing, but not today. It's because of low inflation and because of a weaker currency. The yuan should decline. Our estimate, you'll get me on this next year, is about 5%. I kind of liked it to see it at about 1,200 to the dollar, and I bought Starbucks cappuccino last night at the airport, but it was $5. So it's still expensive. I don't understand what's happening. I thought I might get a bargain at $3. But I go to Japan now. Japan is relatively cheap. Go to Europe for Americans, it's relatively cheap. So you're going to see a lot more Americans around the world because the dollar's strong. A strong dollar is a big theme for us. We think the dollar is king, and the fact that we're now a major oil producer in the world arena makes me like the dollar more. The innards of the U.S. economy look superb inside. This is a healthy economy. The GDP numbers don't do it justice, and we like that. And the fact that we like that for the currency. And the raising of interest rates by the Federal Reserve, and I'll talk about that in a bit, when other areas of the world don't raise interest rates, that's positive to the dollar. Our politics, well, I don't know what you think about American politics, but I have some conservative Republican friends. They're very conservative. I'm a middle of the road or I'm independent and neutral, who say that if Mr. Trump gets nominated, they will vote for Mrs. Clinton. And some of them have said that if he wins, they're going to leave the country and they're going to come to Korea where politics are stable. So it's very hard to comment on politics. So this is an election year, except our budget is in very good shape, actually. And we have done the first little bit of fiscal stimulus in years. It's amazing what growth can do to reduce deficits, especially if it's fueled by easy money. If you think about that, using monetary policy to stimulate, if it works, doesn't cost anything on the budget. It lowers interest rates. That saves money on interest charges. It's not an expenditure. It's not a tax cut, which costs money ex ante on the budget. It's a freebie. If Europe had only known that, when they imposed austerity on Europe, raised taxes, cut spending, made the government fire people, economies fired people, went down in recession. And then the economies did so poorly, they lost revenues. So the deficit GDP and debt GDP targets ex post never happened. If they had only offset that with easier money at the same time. But countries don't do that. Countries don't do that. Only economists do that in the laboratory. Easy money could have taken care of a lot of the negative effects of austerity. And now when you look at the data for Europe, you see 3 unnecessary years of recession from some of the poorest macroeconomic policies, in my opinion, I've ever seen. And that includes some of the mistakes of Japan, which have been very big. Unbelievable, that austerity. Unbelievable. Europe had 2 recessions in 5 or 6 years. The U.S. came out of its downturn. UK came out of its downturn, I would argue, because quantitative easing, aggressively easy monetary policy with long lags, did it. And so the budget is in good shape in the United States. 2+% of GDP. Debt to GDP, because GDP is growing better, is slipping a bit. Our debt ratio is going down. That's positive to the dollar. And in turn, a positive dollar for investors around the world gives a little extra return, if you think that way. And so we see people borrowing on a very cheap euro and out in Europe and using it as a fund source for trading and investing in dollar-based economies. So that very brief comment on Korea, hoping that you'll forget a forecast that might, 2% growth. Elsa Sakong was nice enough not to remind me that I think last year the forecast was 3% growth, and Korea did not do that. It's the first time in years I really missed the Korean growth number. It looks like it's coming in around 2%. So the growth struggle. Well, the growth struggle is clear in data around the world. Most of the world economy and regions, global regions, have slowed down immensely in growth. And this is true even since the beginning of the recoveries starting in the U.S. in 2009. The numbers are anemic. They're slow. They're weak. Lots of crises, economic and financial crises. Struggle is for growth and the weak growth of a weak recovery. And so we have views that this is the way it will forever be, new normal. Rationalizations of that by very prominent and thoughtful economists. And we have views of an aging but still optimist, economist, observer of the scene, that would observe that throughout the world, the political propensity is to grow economies faster. Politics ultimately dictates that. Otherwise, countries vote out if they have elections. People in power, they know that. It's the economy stupid kind of thing. Or there is political turmoil and instability, as we had in Europe on the unfortunate policies of austerity. And then you have worse results because of that instability. In the major countries of the world that are growing nicely, we have relative political stability, and that's very important. No matter how critical we are of those who lead our country, and every country is critical, most leaders in most countries have very bad poll ratings. No matter how difficult whatever Congress or Parliament or body of politicians that represent the people might be having. In the major developed countries of the world, we have stability. In the emerging world, the developing country world, except for China, we do not have stability. It's not just economics, it's a lot of other political reasons, and in the Middle East, it's terrorism. And a situation in the world that none of us have ever known. We from the West don't understand the mentality of what's going on, and we see horrific, distressing, terrible things going on with then reactions ranging from, in the U.S. political scene, lock them out, the Muslims, don't let any Muslims in, to other more reasoned, I'd be on the more reasoned side of checking the entrance to a country. But in a place like the United States, where immigration has been so important to us, our development, our culture, where people have come from all over the world, contributed to our society, our economy, and to clear thinking on what we should do for our people, I'm a big fan of immigration, and I would be on the side of careful examination of people who come in. And unfortunately, we then take a risk. Philadelphia, the attempted execution of a policeman in a car by a gentleman who claimed, and he'd been to the Middle East, that he was carrying out the dictates of Islam or ISIL. I don't think any of us have seen anything like this ever in our history. It's disconcerting, but you know, economies go on. Markets buy and sell. Unless this stuff fundamentally changes the fundamentals of economics, it is hurting growth around the world, but in a big way. Business people move on, try to make a buck, consumers try to do their job, households try to do their job, and people in financial markets, the traders and investors, do their best to earn good returns and kind of follow their noses. Well, the growth struggle is evident in the U.S. data for the last 4 or 5 years. On average, 2.25% to 2.5% real growth of real GDP. It's evident in the numbers on China. It's evident in the GDP numbers on Japan, on Korea. In Korea, it's evident, though very prominently, in the developing country world, where after years of 8% growth in real GDP terms, we're now down to, and we're looking ahead at, 3 to 4% growth, and that includes a Chinese number of bottoming out at 6% before Chinese growth picks up. That Chinese number, because China is classed as part of the developing world, it's weird because China is a developed country, but as part of the developing world for purposes of these numbers, the number would be less than 3 to 4% if we X'd out China. That lump of countries is now 33% on our calculation of world GDP. It's 1/3 of real GDP. And so the emerging developing world is a force in terms of the macroeconomy. And therefore, I don't go to sleep at night because any place in the world can come up with numbers that we have to analyze that can have effects and mean a lot. The U.S. share is lower, the European share is lower than it used to be. That's one big change that has brought about the struggle for growth. The role and size of the developing world after years of boom. A second is the shocks. When I say shock, I'm talking about things that happen that are not like much of history, that seem to come out of the blue. They're not, they're developing. And we have 3 huge shocks in process, conditioning the slow growth, but also offering promise for the future. One of them is the oil shock. Crude oil prices have come down over the last less than 2 years from $110 a barrel to approximately this morning $31. That's about $80 a barrel. That's a huge decline. There are winners and there are losers. The oil producers, the oil companies, countries are hit very hard, so hard that you can only think depression if revenues depend on oil prices. In the United States, that's the mining sector, thankfully very tiny. Jobs losses this year, no gains. In the world economy, it's a place like Venezuela. It's part of Canada. It's even China that produces 500,000 of oil, that side of it, per day. Certainly it's OPEC in the Middle East. And it is in the United States. And then part of what's given force to that huge decline in oil prices is weak global demand. The biggest part, we think, is a supply-side shock levered by the United States, technological change called fracking in the United States, which really has disrupted global oil markets because the U.S. now is a major producer in aggregate, over 9 million barrels a day, third only behind Russia, number 1, and Saudi Arabia, number 2. Suddenly, and this is what technology can do, particularly happens in the U.S., a force on the supply side of the world oil market. The geopolitical reaction to that was something I actually thought would happen. It was the Saudis not cutting production because oil prices came down, but instead keeping production up as the low-cost producer, quite predictably, continuing to produce, understanding that if prices went down, Saudi could survive it, but lots of other countries couldn't, and particularly the shale oil producers of the United States could not. That's a geopolitical, non-economic response, except if you use game theory, oligopoly theory, you might get to that. That was the Saudi response. Now, when they did that, my reaction was, OPEC as we know it is gone. The world oil market will never be the same. I have that view today. It is not the same. It will never be the same. We will end up with several big suppliers. The U.S. will be there. Saudis will be there. I'm not sure about Russia because I'm not sure about the future politics of that country and how long they can continue this way with their economies so devastated. But nevertheless, it will be an oligopolistic kind of oil market, and OPEC increasingly a small force. The strategy of the suppliers is to stay there because someday the world economy will come back and oil prices will go up and they will then get rich. And Saudis, if they can hang out on their budget, which is eroding some problem, and they can stick to it, will probably end up shaking out some of the suppliers. Iran, because of geopolitics, is coming back on, going to contribute more oil. And so this is very fundamental to much of the outlook and the look ahead. Oil prices are lower to stay from $31 a barrel. This is not a forecast. This is a what if. 15 to 20 is not impossible sometime this year. Now, initially when this happened, the supply-demand framework we use led me to say $60. These things change, though. You know they change because it's a dynamic situation. At 60, we ended up then thinking 40. About a month ago, we talked about in the 30s, and probably we will bottom out somewhere in the range of 20 to 40. This is tough to predict. But once we have a what if on crude oil prices, we can do the effects of that oil price shock, the winners and losers, the producers, suppliers, the buyers. And it's interesting what you see. In the United States, you see the footprint of what you should expect. Mining is in a depression. Texas, Louisiana, states are in terrible shape. Manufacturing is in a recession. Now, part of it is that the oil price decline is part of commodity prices declining, but it's an umbrella for it. And part of the oil price decline is a stronger dollar. And all commodities weaken on a stronger dollar. They're traded that way. And so we see, particularly in the employment data, we had a very strong employment report on Friday, very, very strong. We see exactly what we should expect. Those two parts of the economy are doing terribly. Recession, depression. The other part of the economy that benefits from lower oil prices, lower gasoline prices, $1.90 a gallon in my neighborhood. A couple years ago it was $3.60. Typical household, we have calculated, saves almost $2,000 a year just on gasoline alone on a typical car, typical driving schedule. U.S. interest rates go up a quarter. It costs a typical household about $800 on the mortgage. Very beneficial to both saving and spending. And the money that is freed up in terms of extra money flows and lower inflation shows up in the household balance sheet. The measures we use tell us American consumers' household balance sheet is in the best shape perhaps ever. Not only have American consumers deleveraged, they have done more, and the oil price pump of freeing up disposable income adds to that. And so what do we see? The last 5 quarters, we see consumption spending in aggregate rising 3% plus inflation adjusted. That's year over year. The 5 quarters before, and this is in one of the articles that we provided for you, 2.5% year over year. And before that, 1.5% year over year. Consumption spending is ratcheting up 69% of the U.S. economy, and here is the optimism about the U.S. economy. And it is largely services, but other, like automobile sales as well. That's the pump. Consumption in the aggregate in the United States is over $12 trillion. That is larger in the world economy than China. China's GDP in dollars is 10 trillion. And it's almost as large as the EU, which is over 13 trillion. The consumer economy out of the United States is a big deal for the world, and we buy a lot, directly and indirectly. So that is our hope and expectation that that part of the U.S. economy will give us 2.9 or 3% real economic growth this year. That's up from 2.4, and in turn provide some stimulus to parts of the world that America buys from, including Korea, automobiles, electronics, all of that, and provide some stimulus to slow-growing parts of the world like Japan, like China, and to the Eurozone, which is showing some nice, firm numbers now. And then in turn, those parts of the world where they are aggressively stimulating, the case of China, through zero interest rates and quantitative easing, it's working. It's very slow. It was slow in the UK. It was slow in the US. Long lags. And in the Eurozone, it is working. But those countries will stick to it. They've told us they're going to stick to it. And we will see better results on real economic activity, including China, but later this year and next year, to give us, the global economy, a higher path of growth. For the global economy, as we measure it, 2.7, 2.8% this year. Last year it was 2.5%. It's pretty anemic compared to history. But remember, it includes the developing world, which is, in our estimates, growing just 3 to 4%. And then 2.9 or 3 in 2017. With the improvement in the U.S. and global economy should come after seeing low, very low inflation rates, rising inflation, not a lot, but a little bit. And only in the U.S. and U.K. would we expect monetary policy to be tighter. We have been told by Japan and by Europe that they will continue easy monetary policy. There's no other choice for China. Korea is a question mark. I think Korea will stay easy. And we will be working to, after struggling for growth, better growth, Some might still call it a struggle. I look at it differently. I think it's going to give us another 2 or 3 years, maybe more, of global economic expansion. The oil price shock is a very big deal. That's one external shock we've analyzed a lot in macroeconomics in the United States. I remember in 1973-75, I first was confronted with it when oil prices quadrupled and we couldn't figure out what to do with it. But what it means is for the oil-consuming parts of the economy and oil-consuming countries, more growth, a lower unemployment rate because of more growth, and a lower inflation rate. You look around the world at all the net oil-consuming countries, and that's exactly what you see. It's huge in terms of the disinflationary impact. We know it's huge because, take the United States, the overall rate of inflation, including food and energy, is 0.4 year over year, which is very low, and the so-called core, which strips those out, is 1.3. That's about a percentage point differential. And you see this in other countries as well. It's huge. It's huge. And because central banks target something called price stability, where they have that goal on the overall inflation rate, that's for the U.S. at 0.4, not the core. They look at the core, but they target it. They're going to stay easier longer because they all have price targets of something like 2%. That is very bullish for stocks. So don't let the stock market fool you at the beginning of the year into being too bearish. It's easy for that to happen. This force that I'm talking about is extremely bullish for stocks. And I wouldn't get in the way of the turbulence because traders are doing that. If you're an investor, it's dangerous. But it will settle down, and there will be some very big bargains all over the world in terms of equity asset allocation and stocks. Well, around this picture of, and I'm not going to give a lot of numbers. I'll follow Paul Samuelson's suggestion. Paul was great. I did some work very early on something called the crunch, the financial crunch, that got me into looking at the financial side of the economy, that got me into doing modeling where we take account of what goes on financially. I think almost nobody else does that in the United States in macro modeling, the integration of balance sheets and real economy, which has been very helpful. And Paul was always, every time he saw me, he wanted to know, because we had a crunch barometer, so he wanted to know what the barometer was reading. I have a feeling that was for investment purposes. Paul, talking about investors, was very astute. I don't invest that much. I appreciate that. Our asset allocation instructions have been pretty good for our clients, but I try to stay away from that stuff. So, but I'll be a little more qualitative. I want to just make one more point about the American consumer, tell you something about underneath, and then a few of the risks, and then we will just open it up to some questions and discussion. We look at 5 or 6 fundamentals of surrounding consumption. We've estimated their quantitative impact on aggregate consumption over the years. So we have the strongest to the least strong. The biggest and most important is, no surprise, disposable income, inflation adjusted. Jobs drive that. The U.S. jobs market is strong. It's in the services sector. Wages are going up. So real income is rising nicely. That's the main fuel for short to intermediate term consumption spending. Flashing positive, strongly positive. That's our expectation for the coming year. We're forecasting the unemployment rate in the U.S. at the end of 2016 at 4.3%. That's beyond the Federal Reserve's measure of full employment. Without a huge inflation going with that, it's a bit of a surprise. But the lower oil prices, that shock, reduces unemployment and reduces inflation. So we should not expect the kind of what's called Phillips curve reaction that we typically have, given the huge oil price shock. We have a second shock. That's a dollar shock. And we've left a paper for you, which is something I wrote a long time ago, 30 years ago, called The Dollar and Inflation. But it investigates and goes through all of the ways that a strong dollar affects inflation, many of which were unknown at the time. We think that applies now. The strong dollar is very disinflationary in the United States. You can argue that it doesn't really raise growth and lower unemployment. I think it does because it increases the purchasing power of households quite a lot for what they buy in the U.S. and buy around the world, particularly imported goods. Imported goods prices are down quite sharply. That means we're paying less when we buy what we buy at Amazon or anywhere else. But let's say it doesn't promote growth because it hurts exports. It hurts U.S. exports and hurts U.S. manufacturing. It is that plus weak growth in other economies that's given us a manufacturing recession. But manufacturing's small now. Our exports are 13, 14% of GDP, so as the dollar increases purchasing power, it's simple numbers. Consumers are 69% of the economy and exports are 13, 14%. But let's put that aside and say that maybe it doesn't pick up growth and lower unemployment, but it would lower inflation. Then we have another shock going on, and this one is going on everywhere in the world. By the way, the lower currencies off a stronger dollar can raise inflation in other countries. The collapse in the currencies, Brazil and in Russia, Venezuela, in part because of lower oil prices. You sell their currencies on lower oil prices because their economies do poorly. They have huge inflation. But when you generally look around the world, what you see everywhere is low inflation. And in most places, falling unemployment rates. That's the footprint of the oil price shock for oil-consuming countries. The footprint of technology, what I call the new technology, I think is more growth, a lower unemployment rate, and lower inflation. What's the new technology? Well, it's not the technology of the 90s, the internet revolution. It's not the computer and chip revolution of the 60s and 70s. It's something different, and we all know what it is because we're dealing with it every day. We're dealing with it, all of our businesses, our advertisements on the internet. The internet's and space, those are the new malls. We don't go to malls. We don't drive. We shop on the internet. I think we're going to be surprised on this Christmas in the United States by the extent to which Americans used online shopping over Thanksgiving and the holiday season, as opposed to going by foot and by car to the malls. I think it's incredible. How do I know? Because even I, and I'm the last one to jump into these things, am doing shopping on the internet. I hardly buy anything now that isn't on Amazon, or at least checking Amazon first. And Costco, which is a wholesale discount, marvelous company in the United States, has a wonderful business model. I can get a rental car price from Costco, because I didn't know they rent cars, and then I call up Hertz or Avis and they'll match it. This stuff is going on everywhere. The costs, functions of so many companies are going down sharply. There's so many suppliers that puts pressure on prices. I know almost no one who doesn't shop on Amazon. Now, whether you should buy the stock now at $600 is another story. But they can make money anytime they want. Someday Starbucks, who I put in the new technology world, will charge us for sitting down and drinking coffee or a cappuccino because we rent space with remote technology and do our work at Starbucks. Every time I walk in, I see dozens of people, and I do it too. I'll sit there for an hour or two and go through the email and read numbers and do things. I can run models on my iPad now that I couldn't years ago. I don't need an office anymore. So in the U.S., you see office space changing. You don't see any retail clothers. You only see food emporiums now. It's huge. It's unbelievable. We don't have the data on it as economists. But I would argue that the new technology is certainly lowering inflation. It lowers the unemployment rate because it kicks out people and kicks down the labor force. I run a company and somebody comes in and says, I can put your whole IT function on the cloud at 1/10 the cost when you put in all those labor costs and retirement costs and all of that, and I'm paid to maximize shareholder value. I call in 3 other vendors, try and get the lowest price, and I install it right away. And those jobs go away. I have interactive conversations now. They're not all so good with machine people who respond and interact. It's artificial intelligence. It's programmed. In the medical world, surgery is becoming robotic. So, we may not have any people working, but guess what? In the U.S., we grew jobs last year, 211,000, 2015, and we grew them 270,000. So there are a lot of jobs. A lot of them are in the new areas. They're just people who do software programming and do different things than work the machines at some automobile shop. We've been through this before. The new technology is huge. In our country, the professional academic thinking is mixed. On the one hand is Bob Gordon, who I'm sure you've had out here. He's terrific. He's a friend of mine. Thinks it's not a big deal. On the other hand, you have a guy like Eric Bernofson of MIT, where MIT is spawning all these new companies in medicine and biotech. Technology Square in Cambridge is beyond belief. The waterfront of Boston, you can't see the water anymore. So many buildings have been built on all this tech stuff. It happens before our eyes. And the stock market tells us, because the stock market prices in advance, it overprices. But if you look at the S&P 500 and the portion of the S&P 500 companies that would be called qualitatively new technology, the capitalized value is growing like mad compared to the rest of the companies on the S&P 500. So that's not so good for Korea unless Korea's into this kind of thing, but Korea always has been into this kind of thing because it ultimately makes it harder for the goods and hard goods manufacturers, the automakers, to have a big volume of business. But in America, we're buying more cars anyway. So I think it's about this shock lowers inflation. I think it raises growth and lowers the unemployment rate. And what do we see in the U.S.? We see surprisingly low inflation. We see a low unemployment rate that for the Federal Reserve looks like it's the full unemployment rate, but it really isn't. We can go a lot lower. And we don't get the inflation response in the labor market or the price market. We will get a response in the next few months of higher inflation because last year oil and energy took the index down so much. But our view on inflation is it's going to run low. And when I look around the world, the same thing is happening because the technology I'm talking about is going on almost everywhere. It raises growth, lowers the unemployment rate, lowers inflation. 3 huge shocks, unlike what we see in most business cycles, giving us a different kind of business cycle. Finally, for the Federal Reserve, we are expecting 2 rate hikes. I'm sure you would ask this. Not 4, which is implicit in their forecast. The reason for that is we think inflation is going to be lower than what they think. And our belief is the federal funds rate is a function of the inflation rate and how close in the speed of its approach to what is now the unachieved target and goal of the Federal Reserve, getting to 2% inflation. And so whatever happens to inflation will drive our forecast of the federal funds rate. At the moment, we're looking at inflation that would average 1.5% by the fourth quarter of next year. The Federal Reserve is higher. And so we are forecasting on the path of inflation, and this is very difficult, a hike in March, another hike in September. Implicit in the last Federal Reserve statement and their own forecast of the rates are 4 hikes. The one thing I'm pretty sure of, they won't do it a quarter by quarter. They've told us that. They won't do it. It will depend on inflation. Those are very small interest rate hikes that would give us a 10-year Treasury yield at the end of the year if it's our path of about 2.5 to 2 3/4, and if it's their path, 3% or so. So long-term U.S. interest rates, unless inflation surprises on the upside, if it does, bond markets around the world will get slammed. But as long as it stays on the low side, interest rates will stay relatively low, and that will temper somewhat the dollar increase. Lots of risks out there. But at the beginning of a new year, I hate to be gloomy. I am an optimistic, aging economist. On average, that has proved helpful. And I would encourage everybody as a psychological kind of thing to stay happy and upbeat, and to don't retire. Those of you who have, don't retire. Those of you who have, God love you. Have a good time, play golf, go ski, do whatever you want to do. But I'm not sure spending more time at home is a curse, a blessing or a curse. In my case, for my wife, it would definitely be a curse. I'm a very difficult guy. Thanks very much. We're going to take some questions now.
Was saying, I've been saying that all along too. China will slow down, is expected, but won't have any hard landing as such, which may be below 4% or 5% growth rate. Maybe somewhere around 6% is all expected. And global economy, fortunately, despite all the volatility and uncertainties, and this year will be a little bit better than last year, and the next year will be a little bit better than this year. So anyway, his message is optimism, maybe cautious optimism, but in any case, that is bottom lines. Since we don't have much time left, and Alan Sinai never retired, and he's really keeping himself really busy, and he's on his way to Tokyo this evening, so we can have a very long session again this morning. So why don't we invite some more comments and questions from the floor? Yes, Dr. Kim, please.
Good morning, Dr. Sinai. It's very good to see you as always. I have a couple of questions. First, you mentioned the trader instinct of running away from the dark cloud. Now, this brings up another question. When the traders run, they not only run, but they try to outrun each other as fast as they can, naturally causing overrun of whatever is the equilibrium target, which then creates another problem eventually to reverse. My question to you is, if you would stretch your risk, how long would that be, that period? This particular overrun will reverse itself is the first question. Second question is, you mentioned the renminbi is overvalued, but the magnitude you mentioned is something like about 7% to be reversed by the middle of this year, if I heard correctly, which comes as a little bit of a surprise in view of their continued surplus in the the current account basis. What are your reasons of thinking that high a overvaluation? Thank you.
Yes, thank you very much. For the traders and trader reactions, that is almost always an overreaction. Traders trade momentum, and once it goes, they don't think about anything else other than momentum, and it gets overdone on the downside. As long as the fundamental uncertainty and fear stays, the unknown about China, I don't think the cloud goes away. Now, how long is that? Depends on every event. In August, it triggered, along with other things, a stock market correction around the world. This one, from the levels we were at, tremendous amount of value was lost, but not yet a stock market correction. So I think if it's adjustment of the exchange rate, and that fundamentally is called for, I'll get to that part of your question, and that becomes clear, and if we should happen to get a good number or two on China, it will totally reverse. What spooks me is, of the sellers, for something that goes down 7% in almost a heartbeat, there are people in China who sell. They do know something about what's going on in China. They live there, they work there, they invest there. And so if I trade, that bothers me. And so I'll be very cautious about going back in until the coast is clear. On the currency, it looks like it's outrun itself on the fundamental estimates that we use. I gave you an estimate of 7 to 7.25. There are forecasts as low as 7.6. That, in my view, is overdone. And that has been today in commentary out of China argued. They argued what I just argued, which is that this is just adjustments for a market-based currency and nothing more than that. The economy is weakening. The Chinese acknowledge that. But that fear of it being overdone and collapsing is, to me, not plausible. As an investor, when you go back in and buy, you know, valuations will adjust. And when they look really low, and if you're confident in the longer run prospect of a market, an equity market, when it looks cheap, you buy. Strategy, I always suggest a little bit at a time, tiptoe back in and watch to see if the coast is clear in terms of the information that comes out. And that would be the reaction I would have to this. China's a high risk, high beta equity market to buy and sell in. We do not advise it for investors generally, unless we are really, really confident that the Chinese stock market is in a bull run, both strategically and tactically.
Okay. Other questions or comments?
We have time. So,
yeah. In the meantime,
time.
let me ask you your view on this. You know, you mentioned Professor Gordon. This old macro statistics so far shows slow productivity gain, and despite your new technology and technological development. Is it because of measurement problem, or is time lag involved and show up in the data?
Right. Yeah. The question is the U.S. has very low productivity growth showing up in the, I call it the macro data, and then Ilse Kong was wondering if it's a measurement issue. I do think it's a measurement issue. The profit margins of companies are at record highs. Are probably going to come down a little bit. That tells something about productivity on the micro side. And in the 90s, the micro data told the story. The macro data were wrong. The macro data, the numerator, is a GDP-derived item and doesn't really reflect the structure of the economy as it is. I think more thinking about this is starting in the U.S. The National Bureau of Economic Research has, in the Conference of the Research on Income and Wealth, taking a look at how you measure the new economy. So I think, like in a lot of instances, 5 years from now, when the new data are produced and we have new ways of measuring what goes on, we will discover that productivity was a lot better. In the work I do, I can't wait for that. So you have to make a judgment based on whatever evidence you have. Some of it's anecdotal, some of it's analytical. We just don't have the right time series on it. And that's part of why we have controversy. You can't settle it by data. Eric Bernausen at MIT will argue that this is, in the vernacular, the greatest thing since sliced bread. I think it is. I think it's unbelievably huge for the world. Bob Gordon says it's not like the, well-reasoned, he's one of the world's leading experts on U.S. technology history. It's not like the automobile, not like the airplane, not like the computer, not like any of those things, and he sounds very plausible. We won't know for years. So the judgment I make now is it's one of the greatest things since sliced bread in the vernacular.
Yeah, I think statistical problem is. I tend to believe in the argument you just said. For example, in China, some people suspect that the official statistics are not really correct ones, and some pessimists are saying that current Chinese growth rate is maybe even below 5%, and then some of statistics they show rather than government published macro data, they say, okay, look at how much oil consumption, energy consumption they had, and then how much the people's the gasoline consumption, or all the physical, logistical data and so forth. So if you look at those traditional the data, it may seem that Chinese economy is slowing more than the macro data shows. However, now China's Chinese service sector is increasing much faster than manufacturing. So if you use traditional figures and statistics, that may mislead to this, because those are not picked up by these physical movements. And there are more services, and so less energy intensive, and less movements, and less gasoline using and so forth, because people used to internet shopping and so forth. So I think there is really measurement problems in all macroeconomic statistics. But now this, things of the Internet of Things and all these things, it really makes revolutionary changes, but it's not showing up.
Yeah, we economists, this is for the audience to understand, we are trained not to look at anecdotal evidence, because it's not random, it's not statistically and scientifically drawn.
Yeah.
It's interesting to me that in my profession, and I'm an academic in part, that's how I was trained. And yet, in the world of reality, I get incredible insights from anecdotal information. Now, I do think I have an analytical framework, and I can look for data to support that. And from the clients I deal with, they're very anecdotal, and they're often so right. So where do you turn for evidential views? I end up going to the employment data, because companies that hire are hiring because they think they're going to make money, or there's prospect of revenues. And when I see healthcare, 13.1% of non-farm payroll in the United States, having grown from about 7% 10, 15 years ago, and manufacturing at 8.5% of the total. Guess what? Healthcare is the fastest growing sector in the U.S. economy. It's a lot about what the economy is all about. So I look at the anatomy with employment data, because companies put money on the line to hire people and fire people, and that's a real test. And I think it's more of a discipline than what the data providers do in Washington, behind things. The other is the stock market. And I know the stock market's going to overdo it. It's all kinds of irrational kinds of things happen. But when I see S&P 500 companies being replaced by the new companies, Twitter, Google, now called Alphabet, or that may be on NASDAQ, there's more on NASDAQ. And then I look at what the market value is of that lump of companies, as opposed to the S&P 500. Here's how it looks as a proportion of the S&P 500. That says that a lot of smart people, they're not the smartest, right? We had Wall Street was egregious. We all agree on that. What went on Wall Street was horrible. But when it comes to putting money down, other than one's life, for some people that counts more than anything. That's a real test. And when I see it growing like Topsy, that tells me something about what's going on under my very feet before the economic data that my profession puts out. So I'm just being transparent with you about why I have the reactions I have on perceptions. The anecdotal ones are... Alan Greenspan always told me in conversations that he thought he could take anecdotal data and do something with it. He was not trained at one of our leading universities in technical. Sometimes it's bad to have that training. You close your eyes to stuff that might matter. And he thought he could do that. I kind of said, no, I don't believe you. But I think, if you do this enough years, you can put a framework around it. Your comments about China are very interesting to me, because you go there and you have a conditioned response, and you're probably right.
Yeah. That's all I tend to believe. I talked with many Nobel laureates and many distinguished economists last year, and I found more of them, interestingly enough, they believe in these statistical problems and measurement problems. Mike Spence, for example, he's saying that, Robert Solow made a mistake in earlier period.
I agree with that, actually.
Alan Blindel recently also. So
the residual.
You can see what's happening, and the productive changes much, but it doesn't show up on statistics.
Yeah.
And how about, your view on the Larry Summers' secular stagnation thing, which is a more long-term thing? But
Well, here's the other thing we do. We have to be aware of it, what economists do. You have a history of data. And I think I would modify what John Kenneth Galbraith said, which he said that we forecast because we're asked. There's some truth in that. And if we're paid, I guess we should do it, or we have to do it. And I think economists have to explain the data. And so we are very good at rationalizing data out of history. And our profession is filled with paradigms that came from the data of history that did not hold up in the future. So Larry has an extremely articulate, well-reasoned secular stagnation view, which had only a small segment in our history. And Bob Gordon has the same view, but it's for Bob, it's wrapped up in productivity, which I think is mismeasured.
Yeah.
And for Larry, it's wrapped up in a lack of aggregate demand
yes.
that the government can solve by spending more money.
Yeah.
So we'll have to see what happens 5 or 10 years from now when we have a longer span of data to see whether we had the... There are a lot of reasons why we've had in the world lousy growth, low inflation, stagnant expansions coming out of the horrible downturns that we had. We're getting beyond that now. It shouldn't stay beyond 5, 8 years. But we rationalize history as economists. The natural rate. I don't believe in the natural rate. That was Milton Friedman. Rationalizing the data of history. He was a master at it. It was a marvelous contribution. But the natural rate, where is the natural rate? We're at 5% unemployment. Inflation has been decelerating, not accelerating. The last time we ran into this in the 90s, the second half of the 90s, the natural rate was 6%. We got down to 3.9% unemployment rate before we had inflation accelerate.
Well, okay, we can go on like this all day, but we have to let Dr. Alan Sinai go. And now he's becoming really a fixture at the IG as a New Year's beginning session, and we're looking for, we of course hope you never retire. And,
well, you and I will sign the pact, right? We may be the only people here,
right.
But we will still be working.
We are friends for many years. Well, we have to end here, and I really appreciate
thank you.
sharing your
Thank you so much.
insights. And
Thanks for coming.
Please join me in thanking you.
Thanks. That was very good.